Eugene Profit, who unsurprisingly is the manager there at Profit Investment Management. Thank you for joining us.
Thanks for having me, Prue.
What's been the key to success over the past recent period?
Sticking to our knitting. We actually,
Sticking to your knitting.
Absolutely. We bought technology stocks in the summer of '98, and we thought November of last year that technology had gotten as cheap as it had been since the summer of '98, so we began to buy more technology shares for the first time since then. Well, our November performance suffered, our December performance suffered, but coming into the new year, that bet, wise bet as I call it now, paid off, and so we've performed quite nicely because of that. But because we are value and we also own financials, we also own pharmaceuticals, our performance last year wasn't so bad, in comparison to our technology weighting.
Does that mean going forward that you're not going to have spectacular gains, but you'll just continue to motor along nicely?
Well, that's our intent. I mean, we don't want to be the top performer, we don't want to be the worst performer, but we have been a very good performer consistently. What we try to do is fill our portfolio with names that we figure will get us a 60% return over a 3 to 5 year period, and we buy them at a time when no one else is interested and hold them until they come back in a favor, and that's performed quite nicely for us.
I'm curious as to why you like EMC, because it's in a sweet spot in terms of the tech market,
right.
Leader in its field, but its PE would suggest that it's extraordinarily expensive.
You usually would say that that's a growth investment or more of a growth type investment. We bought EMC when it was $6 a share. It's been as high as 104.
Smart, but
that's
would you
right.
be buying now?
Not necessarily. We were buying when it was back down in the $55 to $60 range over the last few weeks, and so we've enjoyed the run up. But I don't think we'd be a buyer here at 80. But we're not a seller. We haven't seen the product change. We haven't seen the demand for the product change, and the management's very strong. As you saw a couple of days ago, they exceeded their earnings expectation. A company that has that higher expectations still exceeding expectations, that's a rare company.
Interesting, because when you point to the earnings, revenue was up 40% year over year.
Absolutely.
For how long can they keep that up?
Well, the chairman comes out and says that at least they'll keep it up, over the course of the next 12 months, which is our initial concern. Whenever you have an industry leader like an EMC, if you go back to the 70s, it was IBM. In the 80s, you might point to Cisco. Eventually everyone jumps on and thinks that this company can go to the moon. Well, we know that that does not happen, but we also know that why it's going on. With the growth of the internet, EMC is in a great spot, and they are a market leader, and they're killing all competitors.
Now, current price 79. Credit Suisse came out yesterday and upped their price target to 105. Where do you see it going?
I think it'll get to there. I mean, that's not surprising. I mean, it's been to 104. It's all-time high. And so as long as the stock is performing as it has performed, and we get a little help from the Fed and the market environment begins to move up, I think EMC will probably go up to that 104 level without much trouble.
Talk to me as to why you like Disney in this environment. Some people saying difficulty at the theme parks.
That's right.
Why would you like it now?
Well, I think that actually that they are getting advances from the theme parks now. For the first time, they're getting participation from Paris, Disney. And if you were down at Disney over the holidays, they were shutting the park down to new people coming in because there was so much demand. I think the weakness is a result of a little bit of softness at ABC. People concerned that Who Wants to Be a Millionaire is not as strong as it was last year. But Disney is a great collection of assets. They have great internet companies. And we look at the valuation of AOL, Time Warner, and now they're in the same industry. Disney is much cheaper, and I think that...
Better run, do you think?
I think maybe at the end of the day that will be proven to be the case. I think that the jury's still going to be out on the AOL Time Warner merger. Whenever you have a large merger like that, there are some hiccups. They have great managers there, no doubt, from the two different firms. But I think it's going to be a couple of quarters before we know just how they integrate together.
Eugene, why does Franklin Resources meet all your criteria?
Well, because it starts off with a great return on equity. They're at 17, 18, return on equity. The PE is probably the cheapest of the asset management firms of its quality, and that's as a result of them being more of a value shop and value being out of favor. So their income wasn't as high as it had been 3 years ago, but as you know, last year there was a return of value. They also are very strong internationally, so I see it as a play on a couple of different themes. As we broaden out the market environment, as we begin to look internationally, as we begin to invest back in value, Franklin Resources should be one of the beneficiaries, and it's cheaper than the rest of its peers.
Just very quickly, in the past you've been investing in utilities. Was that a mistake?
No. I think that we actually missed some of the run-up last year in utilities as they became more technology-oriented companies. I think as an investor you have to look across the board and be completely diversified. I think this year I don't think you'll get much from that area. I think that just all the defensive sectors from last year are probably a little bit extended, so you have to look elsewhere. But there's a place for it in the portfolio, sure.
Eugene, thank you.
Well, thank you, Prue.